current scenario suggests we might be witnessing the rapid decline of American economic dominance, reminiscent of the sudden economic downturn in 1974. This decline could unfold with alarming speed, driven by aggressive monetary tightening and a swift escalation of prices. The coming months could be particularly challenging, both economically and in the financial markets. However, what happens next is crucial. If the Federal Reserve pivots as anticipated, halting their interest rate hikes, potentially with June being the last increase, and re-evaluating their strategy in response to the deteriorating economy, the focus will likely shift. The Fed might hold off on quantitative tightening QT, meaning they won't proceed with reducing the size of their balance sheet. The conversation could soon turn to interest rate cuts, but with rates already low, the Fed's options are limited. In such a scenario, the Fed might resort to printing more money as credit markets begin to constrict and the housing market shows signs of decline. Printing money, however, is akin to currency debasement, a concept historically practiced by both the Romans and the Chinese. Currency debasement works on the principle of scarcity. If something is scarce, like a bottle of water in a dessert, it's highly valuable. But if you suddenly have an excess of that item, say, 1,000,000 bottles of water, its value plummets due to the lack of scarcity. Similarly, if a currency is overproduced, it loses value. This is the risk associated with excessive money printing, where the value of the currency can diminish due to its abundance. If Leonardo da Vinci had created 50 million pieces of art, their value would plummet due to their abundance. This illustrates the principle that scarcity drives value. When something is devalued in comparison to another asset, its relative worth changes. For instance, we're not increasing the number of shares in the S&P 500. In fact, through buybacks, we're reducing them, which generally causes their value to rise. Similarly, real estate often appreciates over time due to its relative scarcity compared to expanding Federal Reserve balance sheets. Gold and crypto follow the same pattern. The key lies in the pace at which the Fed deploys its balance sheet. This balance sheet magic can optically transform markets. If market values rise, household net worth stabilizes, consumer spending may rebound, and companies might halt layoffs. It's almost like a sleight of hand where, traditionally, markets gradually improve the bull going up the stairs, but can crash rapidly the bear jumping out the window. We could either face a situation similar to the 2000 recession, where the market corrected itself over 18 months and the Fed gradually lowered rates, or something akin to the 2008 crisis. In 2008, the Fed's use of its balance sheet effectively halted the downturn, especially after rate cuts alone proved insufficient due to banking sector issues. The Fed has repeatedly utilized this strategy, notably in 2010, 2012, 2016, and the 2018 Powell Pivot when the Fed shifted from rate hikes to cuts under pressure to support the economy. The challenge now is the high debt levels and an aging population, which make the economy more sensitive to rate increases. Currently, with many employees not returning to offices, real estate investment trusts' rights owning office buildings are facing challenges. Moreover, the Fed is grappling with a massive $30 trillion debt, along with $200 trillion off-balance sheet liabilities. Despite the historical pattern of rate cutting and balance sheet manipulation, the question remains whether these tactics will continue to work, especially considering the unique challenges of today, such as supply chain disruptions, the impact of COVID-19, stagnant wages, and the potential erosion of household net worth in a highly leveraged environment. The current financial situation involves extensive borrowing against houses, equities, and even further borrowing on top of that. There's a risk that allowing the value of collateral to decrease could jeopardize the whole system. One approach being discussed is student loan debt forgiveness, a form of debt relief that aligns with modern monetary theory (MMT), which seems inevitable regardless of personal opinions. The strategy being employed is financial repression, where the aim is to have inflation rates slightly higher than interest rates. The goal is to diminish the real value of debt over time. Consider how the mortgages of our parents' generation now seem insignificant. This is because inflation has increased the value of their homes over time, while the nominal value of their debt remained the same, making the debt relatively smaller in the end. In essence, by devaluing money, the real value of debt is also reduced. This is beneficial for those in debt, but problematic for lenders. The debate then shifts to fiscal stimulus strategies. A typical Republican approach might involve cutting taxes and increasing spending. However, this doesn't necessarily address the needs of the most disadvantaged. Instead, it exacerbates the divide between the wealthiest 1% and the remaining 99%. This disparity is increasingly visible and challenging to resolve. The core issue is the Federal Reserve's balance sheet. As more money is printed, the value of expensive assets continues to rise, disproportionately benefiting the wealthy. Implementing a broad fiscal stimulus is complicated because it tends to make the rich even richer, failing to address the fundamental problem of wealth inequality. The current debate centers around whether to directly support those most affected by economic challenges, or to do nothing. However, doing nothing isn't a viable option anymore due to the immense global debt, which is around 400% of GDP. This is unprecedented in economic history. Reflecting on the 1940s provides insight into a similar scenario, marked by severe supply chain issues and high inflation, leading to an economic collapse. Subsequently, interest rates dropped and stabilized, primarily due to the Federal Reserve's interventions. Inflation remained moderately high, about 3%, while bond yields were around 2%. This scenario of negative real rates proved highly beneficial for asset values. During the 1940s and 1950s, there was an economic boom driven by several factors. The war debt's value diminished due to financial repression, and asset values, including housing and equity markets, surged. The equity market rose by about 900%. This period also saw significant fiscal stimulus, necessitated by the post-war rebuilding efforts, and companies invested heavily in new factories. In the current context, we might see a similar trend with factories being rebuilt in the United States and Europe, rather than China. Although the use of robotics might limit job creation, it still acts as an economic stimulus. The government is likely to introduce its own stimulus measures, with interest rates expected to stay relatively low and inflation to be slightly higher but manageable. A period of stability and economic growth could be initiated. The technological advancements and significant developments happening globally also contribute to this potentially optimistic scenario, where stability and a boom period could ensue. My belief is that we are likely to navigate through the current economic challenges in unexpected ways, reminiscent of how the world felt post-World War II. In 1948, amidst massive inflation and widespread devastation, it seemed like the world was on the brink of collapse. However, this period marked the beginning of remarkable developments. It saw the emergence of the US as a global superpower, the reconstruction of Europe, the rise of Japan, and significant technological advancements. It was also the era of the Bretton Woods Agreement, establishing the US dollar as the world's reserve currency. This period laid the foundation for institutions like the IMF, the World Bank, and the United Nations, all around 1947. This transformative period is reminiscent of what's referred to as the Great Reset, or the Fourth Turning, a phase of profound change and re-evaluation. We might be approaching the culmination of this fourth turning, or perhaps it's another step towards an inevitable shift. The financial crises of 2008 and 2020 have been pushing us towards this direction, signaling a need for fundamental change in how we approach global economics. In this context, the bond market often reflects the truth, focusing solely on future inflation rates and economic growth, unlike the stock market, which is influenced by earnings and emotions. The bond market is more direct and often accurate in its predictions. This could signify a structural shift in the global economy. Now could be an opportune moment for wealth generation. Macroeconomic shifts, such as the decline of empires, often follow human generational cycles around every 20 years. These shifts bring about major changes, and we are potentially in one such transformative phase. The fourth turning is often marked by weak leadership, which seems evident today. However, it's crucial to remember that relying on past strategies in changing times can be risky. Bull markets can make even uninformed investors appear smart, but bear markets reveal the true extent of their understanding. As Rowell suggests, this realization might come swiftly, revealing the true acumen of many who have prospered in recent times. The key takeaway from today's discussion is to be aware and prepared. The economic shift, when it happens, could be abrupt and intense. This is reminiscent of the warning at the Davos meeting by the IMF about facing significant economic challenges ahead. It's an important moment to be vigilant and adaptable.